Yes, sir, you can start, sir.
Yeah, very happy evening to all of you. I welcome you all to this CP meeting on Ind As, AS 36, pardon, impairment of assets, one of the important accounting standard where the text or the the things look very easy, but when it comes to practicality, there are a lot of challenges where this AS is concerned. So with us joining, we have CA Virinchi Nandula from Hyderabad, who will be taking us through the intricacies of this AS. Before I request Abhishek to introduce and take things forward, I will request our treasurer of SARC of ICA, CA Geeta AB madam, to share her thoughts with all of us. Geeta ma'am, over to you, please.
Yeah. Good evening, one and all. If there is anything is constant in this world, it is change. At the outset, I would like to appreciate the efforts of our dynamic chairman of SARC, DC Jain sir, and Secretary Abhishek Murli in conducting the series of CPE meets and successfully conducted the first virtual conference Sigaram. I also recognize the speaker of the session, CA Virinchi from Hyderabad, for deliberating today's talk on Ind As 36. So of late, we have been witnessing the change over all the domains, be it a business environment or work culture and whatnot. With interruption of movement of people and goods throughout the world, with the government imposing restrictions on individuals and businesses, the resulting impact on financial reporting will also be very significant. Since this COVID-19 has triggered the recognition of the broad economic effects of the outbreak in the financial statements, we need to equip ourselves with the relevant changes in the accounting standards and disclosures. So the object of this Ind As 36 is to ensure the assets are carried not more than the recoverable value. So with the systematic risk of COVID being pervasive in nature, there is a major challenge of ascertaining the recoverable value of the assets. So hence this accounting standard holds more significant in the current times. And there is also more challenges for determining the time period for recognition of impairment of these implications, in addition to when to test for implications and determining the recoverable amount and appropriate disclosures as mandated. So I'm sure today's speaker for the session would deliberate more on Ind As 36 and its relevance in the present scenario. It will be another value enriching journey for us today. So happy conferencing. Thank you very much. Thanks for giving me an opportunity to DC Jain sir and Abhishek. Thank you.
Thank you, Geeta madam, for giving a perfect start to the program today. I request now C. Abhishek Murli to formally introduce the speaker.
Thank you, Chairman. Very warm good afternoon to all the participants. Dynamic Chairman, C.A. Dungarchan Jain, our resourceful treasurer, C.A. Geeta ma'am was joining us live from Bangalore. She gave a very lovely opening address. And all our beloved participants who joined in to listen to C.A. Virinchi today. I'm sure all of you must be engaged in a very, very hectic close to December. I must firstly appreciate both the chairman and the treasurer. Both of them are very busy professionals, but despite that, they've taken time out to join here today, prepare for the address and deliver the same for all the participants who joined in. So thank you to both the chairman and treasurer. I also have the privilege of introducing our speaker today, C.A. Virinchi, who, as Geeta ma'am very rightly said, is talking on a very important topic, which is impairment of assets. I think impairment is something that should be done very regularly, but you might see it very often that firms don't actually perform impairment study as often as it needs to be done. I think Virinchi today will highlight the complexities and the technicalities involved with impairment. What is depreciation? What is impairment? When is in your unit, even though it is functioning, it can be considered to be impaired based on external factors, internal factors, various factors are involved. So with a lot of practical examples, he is going to take you through today's session. And now I have the privilege of introducing him. He is a person who started his professional journey in 2008 and has been working with the multinational corporations since 2012. He has more than 13 years of experience in statutory audits, and he has exposure in infrastructure, manufacturing, automobile, mining, and technology companies. He conducted statutory audits, group reporting under Indian GAAP, Ind As, IFRS, including SEBI companies, PCAOB, that is the US SEC listed companies, and has even worked on international engagements where he worked in Philadelphia and New Jersey offices. And he is in fact a Ind As expert, and what they called, he's performed a lot of diagnostic engagements in the manufacturing technology sectors, particularly with Ind As. And he is also a very active learning and development leader in his firm, and runs the operation very closely with the lead partner. And he's not someone who restricts his fighting with the clients. He's also a karate expert, and he has a black belt degree in Shitoryu style of karate. And he's also a footballer, much like I enjoy football, so I'm very happy to see Virunchi is also a footballer like that. So this is just a brief introduction about him. He was in fact awarded the best student award at his college, and is a very active speaker. So thank you so much, CA Virunchi, for accepting our invitation to address our members today. We welcome you. We're looking forward to your session, sir.
Yeah, thank you, Abhishek. Over to you, please.
Thank you, Abhishek, for a very warm welcome, and thank you, Geeta ma'am, for introducing the topic and giving out the importance of the topic. So, with the permission of Chairman, sir, probably I will begin the session now. Yeah, thank you. So I'll just share my screen. Abhishek, just let me know once you're able to see my screen.
Yeah, it was visible till now. I think it just, yeah.
Yeah, now it's
perfect.
visible.
Yeah. Am I audible?
Yes, very much.
Perfect. So, good evening, one and all. So, today's topic, Ind As 36. So, already our speakers gave out a very clear need on why this standard is very important. Probably I'll just add a few more points to whatever is already being said. 2020 is one of the most, I would say, one-off case year, which witnessed a lot of ups and downs in terms of economic scenarios. We have seen the year 2020 itself began with a very sharp decrease in companies' operations. A lot of economic slowdown happened in the first quarter of FY 2021. A lot of companies' quarter got washed out in terms of revenue and in terms of a lot of idle time sitting on their plants. And there are a lot of companies which still are witnessing the impact of COVID. So in this particular scenario, one standard where more than 50% of the cases we can fairly see that you will have to revisit this particular standard from a company's perspective. Now, this being the scope of the standard, let's understand one part very clearly. Ind As 36 is applicable for tangible, intangible assets, which are assets which are covered in most tangible, intangible assets. When we look at the scope of the standard, it doesn't cover any kind of impairments coming out of inventory, contract assets and contract fulfillment costs, which are dealt under Ind As 115 separately, and deferred tax assets related impairments are also not getting covered. And if you look at some of these exemptions, in all these cases, there are specific recognition and measurement criteria which are laid out by those respective standards on how they are dealing with impairment of these particular assets. So peculiarly, and even assets where companies have invested in the subsidiaries, associates, and joint ventures, they are covered under Ind As 36. And then, if suppose these subsidiaries are fair valued under Ind As 109, again they will not be coming under the scope of the standard. So the intention of standard is very clear. It covers all the tangible and intangible assets, and specific standards have clearly mentioned whether the particular impairment requirements of Ind As 36 apply or not in those respective standards. So even if we have a doubt to see whether the impairment standard has to be seen or any other specific requirements have to be seen, one can look into the respective standard and check if Ind AS 36 is applicable or not. It's as simple as that. And of course, with Ind AS 116 coming into picture, we also have to note that one significant change that has been brought, all the right of use assets are now coming and sitting under the scope of Ind AS 36 from an impairment perspective. The measurement and recognition criteria mentioned in Ind AS 116 will still be applicable. From an impairment standpoint, one has to look into Ind AS 116. So this is broadly the scope of the standard. So what we are going to do in the next couple of hours is we will look at when an impairment has to be done. We will discuss some basic concepts on recoverable value. We will discuss on CGU concept and identification, and then we will look at specific concepts around goodwill impairment, reversals of impairments, and then we will move towards disclosure requirement. Chunk of the time we will spend on CGU assessment and calculating recoverable value. So that is where most of our time will go in the session. So let's straight away jump into the topic now. So we are first discussing about when should an impairment assessment be conducted. So typically impairment assessment gets conducted at the end of the year. And the most important aspect is if we have to decide whether an impairment assessment should be conducted or not, we need to look for indicators. Before looking into what indicators are, there is one exception which is there in Ind AS 36 itself. With notwithstanding whether indicators are there or not, certain category of assets will shortly come under impairment assessment. Now, what are they? One is intangible assets with indefinite useful life. Intangible assets which are under construction, which are not yet available for use because they are under construction, and then goodwill acquired in a business combination. In these cases, irrespective of whether impairment indicators are there, we still have to test the assets for impairment. So let's understand that assessing impairment indicators and testing or conducting impairment assessments both have different requirements under Ind AS 36, which is one fundamental thing we need to note. That means, what is the implication of this? If in your assets there is a goodwill number sitting, obviously you have to perform impairment assessment whether there are indicators or not. So this is irrespective of whether COVID affects your business or not. Now, earlier also this requirement is there, in the sense starting from when the Ind AS got implemented. Now, one change that we all need to acknowledge is, even if this requirement is there, companies usually roll forward their impairment working, which is also allowed under the Ind AS framework, that you can roll forward last year impairment working in current year. But then there are certain exceptions to roll forwarding the impairment working. So you need to ensure that unless and until the assets which are subject to this impairment, if the CGU changes, then you cannot roll it forward. If there are any specific or new business risks because of which your current impairment working might not be appropriate. For example, if you look at COVID situation, the demand itself is changing in a lot of industries. So you can no longer say that my earlier estimates which are used in developing the impairment calculations or the model of impairment, model assets will not change, but the estimates which are used in the model will still be same, because after COVID you need to relook at your budgets, you need to relook at your growth estimates and all other things to ensure that the current assessment is akin to the economic situation as on date. So now let's go back to again the fact that impairment assessment has to be conducted in specific category of assets for sure, which are intangible assets with indefinite useful life and assets which are under construction and goodwill in business combination. Additionally, you need to look for impairment indicators, which we will see in the next slide. And impairment assessment, the standard says that preferably you should do it at a single point in time every year for consistency. And fundamentally, the expectation of the standard is that your CGUs will remain the same. So if your CGUs are changing, we will discuss what CGUs are more clearly in the upcoming slides, but just give an idea, CGUs are a group of assets which are combined to determine an appropriate level for impairment assessment. So from a CGU's perspective, if there are any changes, then you would have to kind of revisit your impairment working itself. So that, and at the same time, uh, in specific circumstances, changes are there in the CGU, you might have to even disclose. So this is on when we need to conduct impairment and on what assets we need to conduct impairment. So moving on. So now we are discussing about indicators of impairment. Okay. So again, we spoke about COVID, right? So we have standard clearly laid down certain indicators that every company and the auditor has to look for to understand if an impairment calculations are really required or not. And we need to look at these impairment indicators and see the sensitivity involved in these impairment indicators as to which indicator is more we are sensitive of. Not that every indicator which is applicable might be very lethal to the company. There are some impairment indicators which are affecting the company to a large extent and some which are not, right? So we will look at this into broad two categories again, which is laid out by the standard: external indicators and internal indicators. So from an external indicators perspective, the biggest factor that everyone needs to look at it is significant decline in the market value of the asset. So now, what is this significant decline? I'll probably give you a couple of examples. If we look at power industry, uh, for years together, even today, gas-based power plants are suffering because of unavailability of gas. In all these cases, cutting across companies, the market value of power plants, especially which are gas-based power plants, have come down significantly. And every company in this particular stream has recorded an impairment loss. So you can understand the magnitude of problem. Same thing is now happening in the airline industry for quite amount of time, for some time, and telecom industry. So you need to look for if your sectors are actually in that kind of stream which actually has a decline in terms of the market value of the asset. And then if we come to the changes in the technological market or legal environment, again they play a very critical role. Sometimes even a Supreme Court judgment can shut your company operations, and we need to be very vigilant on all these factors. A lot of companies have gone technologically backward and they had to close out. For example, earlier we used to have films, right? Kodak films, we are no longer seeing it. Now they have redefined the company several times, but um, typewriters, for example, have become extinct. Just think about the companies which are manufacturing these typewriters. I mean, we're talking about the technology changes which are very rapid. Even in case of mobile industry, every day new model comes. So you think about how your company actually is impacted by these technologies, whether you are in the industry or whether you are in the profession. How is these technology changes? Are they adversely impacting you, or you are neutral? Are you able to kind of catch up to that speed? Today, all these will play a significant role, and including change in the customer preferences today. So economic environment, if it changes and a particular segment say doesn't get the attention that it usually gets before, say tourism industry. So at least in the first 2-3 quarters in 2020, most of the tourists would kind of stop their plans, right? So that customer change, the behavior and the change of customers also would influence the revenue streams of the company. So I mean, so these are all changes which we need to be vigilant to. Now, in particular, if you can see here, market capitalization is one of the point again that was discussed. Maybe I just spent a couple of minutes on this. So a lot of listed companies around, and if some of you are part of these listed clients, so you may also wonder what will happen if your market capitalization comes below your book value of equity. Even that is a good impairment trigger. Something is incorrect in the way in which assets values are. But we need to note one point here. Again, let's go back to our domain. We are discussing about impairment of tangible, intangible assets and specific assets covered by Ind AS 36 framework. Now, book value of the equity is more a company valuation, not just specific assets. And market forces, especially the stock market forces, the way in which they perceive the stock price would not just be limited to the performance of the asset. Sometimes it even goes beyond that. For example, if the company is heavy leveraged company, in the sense if it has a lot of debt, obviously, if other peer companies are having, not as leveraged as this company is, the stock will be priced differently. And even a small allegation against the company today is going to bring down or dive the stock. We hear a lot of pharma companies which are being subject to frequent FDA checks. Sometimes some negative report comes out in the market and then immediately the stock takes for a hit. Now, what one need to understand is that the impairment assessment might still give a positive result even if the market capitalization is below book value, might be, because the performance of the asset is independent of how the market perceives that entity in terms of how holistically it has to be valued. Still it might be making profits at the end of the day. So, and there is no formal requirement under Ind AS 36 to kind of give reconciliation between the Ind AS 36 recoverable value and the book value of the equity. So from that perspective, while market capitalization is definitely an indicator, companies have to make assessment. If suppose market capitalization takes a hit, especially it falls below the book value of the equity, necessarily every time it may not result into an impairment adjustment. That's what I've been trying to say. So coming from a impairment internal indicator standpoint, again we have a lot of indicators here, which some of them are evidence of physical obsolescence or damage. Even if the asset is directly damaged, it's a direct source of impairment, because obviously if asset is damaged, it will not give you the economic useful life that it was giving you earlier. And if there are plans for the entity to discontinue part of its operations or even full operations, it's important to understand why they want to do it. If they are doing it because they have a strategic reason which does not have anything to do with falling down of the price of these assets, then it might be different. But in most of the cases, if the plan is discontinuance plans because they don't look the future outlook to be positive, that actually is an internal source of indicator for impairment. And even the economic performance of the asset today, like I said, the first quarter of a lot of companies got washed out, right? So you can, if you look at 2021 balance sheets, mostly we might have situations where the numbers are in the red. You might have operational losses as well. You might have a lot of cash crunch, but one needs to understand and look at the holistic picture from a Ind AS 36 perspective, whether we'll still have an impairment adjustment or not. But definitely it's one of the trigger. And as I said, we need to see how sensitive we are to these triggers. So there might be a lot of triggers, but sensitivity and the analysis of this trigger is where one needs to take a decision whether I should do impairment test or not. So if suppose I am in an industry which is not significantly affected by all these changes, I might not even go for an impairment test. So pharma companies, for example, a lot of pharma companies business did not get affected in this particular, not all pharma companies, at least most of the pharma companies who are continue to do research, they continue to keep up their business in these COVID times. Even a lot of technology companies were able to kind of continue their growth streams in this tough period. So we need to look at how we are affected and then take a decision whether to do impairment or not. So again, for both practicing professionals as well as the ones in the industry, we need to be vigilant. We need to see, look for the evidence in documents like board meeting minutes. We need to see, obviously we need to follow the industry. We need to follow the industry. What are the changes that are happening in the industry on a very frequent basis? And then we need to take stock of the financial statements. If suppose even if we are doing the year-end audit, we need to look beyond the year-end and ask for subsequent quarter or subsequent periods trial balance to see how we are doing compared to how we were doing earlier. So all this will help us to kind of get a comfort on the impairment indicators. Moving on. So yeah, I think we are now discussing about CGU. Before discussing about CGU, let's understand again one fundamental thing. Okay, we discussed that we should look for impairment indicators. Okay, now there are impairment indicators, and say company believes that they are sensitive to the impairment indicator and they want to really go ahead and do the impairment assessment. So now what are the next steps? So I need to identify the assets on which I need to do the impairment assessment, right? Now, assets as such might be individual assets or they might be a group of assets. What do we mean? So say there is a manufacturing company. Now, a manufacturing company say has 3 to 4 plant and machinery equipment which are interdependent. So the output from one plant goes to acts as an input to other plant, and at the end of the process in the fourth plant the final finished good comes out. Now the question here is, at what level should I look at the asset to test it for impairment? So it's important to narrow down the asset as per the standard to look for the smallest group of assets or asset which can independently generate the cash flows from other assets or other group of assets. So what do we mean? For example, extending to what I have said, if there are 4 plant and machinery equipments, each of the plant and machinery equipment is independent. If one machine is independently capable of generating cash flows, which has got output which it can be sold in the market, in the open market, and if there is a possibility, then that asset itself will be a independent asset. If not, if the processes are so interdependent that until the final good comes out from the 4th plant and machinery equipment, you will not be able to, kind of sell the good in the outside market, then all the 4 assets together will be one CGU. So this is basically the concept of CGU. Significant judgment is involved in determining CGU. It's not as easy like as I said, because there are complex business models. One needs to look into the structure on how they are operating, how they are marketing, how their customers are actually doing business with them, and then a lot of other factors come into play, which we will discuss in the practical examples. Having said that, determination of CGU is #1 challenge in large companies. Even in small companies, one needs to understand what is the CGU, what is the corporate asset. We will also look at corporate assets in the upcoming slides. So now once determining the CGU, the next step is you determine the carrying value of the CGU and the recoverable value of the CGU. Now we are talking about 2 concepts: carrying value, recoverable value. Now what is carrying value? Carrying value is nothing but the book value less accumulated depreciation less impairments which have been made so far. The net book value after all these adjustments is your carrying value. Very straightforward. So if you are doing a CGU assessment, you need to bottom down your CGU assessment at a carrying value level. So your gross block less accumulated depreciation less impairment adjustments of that CGU is your carrying value of the CGU. Now you are going to identify the recoverable value for that CGU. Now what is recoverable value? Recoverable value is defined as higher of fair value less cost of disposal and value in use, or value. So higher of the 2 is your recoverable value. What is it we are trying to do here? So let's take a simple example. Okay, so the carrying value of the asset is 100 rupees. So what you are doing is that you are computing a recoverable value, which if today, because of the impairment indicators you have on hand and you had to impair the asset, because of which you want to test it, the results of the test, which is the result of the test, is the recoverable amount. If that amount is higher than the recoverable value itself, then there is no issue. Sorry, carrying value itself, then there is no issue. So for example, if the carrying value is 100 and if your recoverable value is 120, then obviously there is no impairment. So how do we compute this recoverable value? You have two options. Either you follow a value in use technique or a fair value less cost to sell technique. We will discuss about these techniques in greater detail in the coming slides. So your impairment adjustment is nothing but if suppose your recoverable value falls below the carrying value. Say in my example, carrying value being 100, if recoverable value is 80 rupees, then you are recording a 20 rupees uh, adjustment to in the form of impairment. So that's the concept of carrying value and recoverable value. Moving on. So next 4 to 5 slides, we will be discussing different practical illustrations on the CGU identification, right? So we discussed about the impairment concept, timing of the impairment. We discussed about the indicators of impairment, and we have looked into the concept of CGU, recoverable value and carrying value. Now we are looking at from a CGU identification standpoint, different practical examples. So the first example which is on the screen, you can see this that it's a mail company basically. So the way in which the pricing is there for the mail company, they're saying pan country level, you can send the goods from anywhere to anywhere. Your price is purely the weight of the item. Now distance also doesn't matter. So obviously, if you give such kind of offer to the customers, so basically they are now having a loss. So now the question is, this mail company has stores across the country. Say they have 30 stores across the country, right? Each store you can track what are the cash flows. Because if I am say from Chennai, I will send a courier from Chennai to say Hyderabad, right? So Chennai store can track its own cash flows. Hyderabad store can track its own cash flows. Each store can track its own cash flows, right? Even if despite of having 30 stores, the way in which the company is approaching to its pricing is saying that my pricing is same for all the stores. So if the company is very strategic, it might have losses in some stores, profits in other stores. The net effect of it might be having a profit for them from an overall P&L perspective. That could be their intention. So, but whatever their intention might be, the way in which the contract is structured, obviously they are looking at all the stores as one store because that is how they are doing even their pricing. So you cannot do an impairment assessment here store wise. You only have to do it as a company as a whole. So that's what I'm talking of. Even if there are different stores, it's not necessary that you would have only one different CGUs. Now we'll look at another example. So the company has a lot of retail outlets. Again, the business model from a management perspective, it's highly integrated. So all the decisions about investments, how you need to function, how you need to buy, a lot of these decisions are centrally taken. Okay, so there is a top management sitting at one place and they're calling the shots. Each store will follow the directions of all the management, and you can see that the purchase operations are centralized. So, and even if the outlet decisions on what has to be bought, what has to be sold, typically one outlet size or group of outlets. Even all these decisions are driven by the head office, you can say. Now, what is a CGU in this particular situation? Now, from management standpoint, management might say that a lot of my costs are centralized, right? If my costs are centralized, why can't I can argue that I have only one CGU? I think it's very important. This concept is very important. A lot of companies, when they make their judgments, uh, would have to consider these factors before they decide on the CGU assessment. Now, how are your stores actually placed? Your stores is suppose the way in which you do business. One store, if a customer is not buying, is there a possibility that the same customer would come to other store and he buys? How independent are these stores? Are they functioning as if they are one store, or even though physically they are different stores? Now, in a retail type of setup, location wise customers will be having. For example, if you have a shop in Chennai, you will have customers from Chennai and so on and so forth. Now, even if your operations are centralized, we cannot argue that these cash flows are independent. So the question is, what level of dependency that these stores have to generate cash flows? From a cost saving perspective, you might want to streamline any number of operations you want. But clearly, so long as these retail stores can independently generate cash flows, you have to understand that the each store is an individual CGU. Even if we take our mail example, the first example that we spoke of, there one can argue that each store is able to individually source cash, but we need to understand the way in which pricing is done. Pricing is done pan India. So in this case of mail delivery company, in this particular example that we have seen, irrespective of where the store is placed, irrespective of the distance, a lot of commonalities are there in the way in which you are doing pricing. So it's very, very strategic. Now, from a retail outlet perspective, so in the first example, there is a lot of dependency in the way in which all your pricing and all your strategy works in terms of how you want to do your business, right? And in these cases, that's not the intention. The intention is to capture local market and ensure that you bank on the common strategic advantages of costs, which will help your profitability, no doubt about it, but your cash flows are independent. Moving on. The next example, again, we are seeing hotel industry. So there are 3 hotels, all same class of hotels, and even the holiday maker. So the tour operator, even if they give an option to holiday maker can choose from any of the inventory from these 3 hotels, and they are fungible in the sense when they give you slots from any of these hotels. And moreover, even if you come as an individual customer to the tour operator, there is a website from where you can book any of the 3 hotels from the 3 sites. More importantly, please understand that all these 3 hotels have same type of I would say facilities. They are a similar class of hotels, so the prices will be similar. In case however you want to book, they are fungible. So in this case, one needs to again note that there is a lot of interdependency. If I compare the mail example that I have given to this example, both would be similar in terms of how they are. So in this case, you might have, say, only 40% occupancy in building C, but building A and B will be 100% occupied. So one should not say that, okay, this is only 40% operate. Every time it is being 40% operational, so I will impair this asset, or there are indicators of impairment, because you can track hotel wise, you can track the cash flows, so still you will have data, right? So what one needs to understand is, again, you might want to fluctuate this, you might want to give more rooms in hotel C, you can manage that booking, right? At the end of the day, the hotel inventory is all the 3 hotels put together is your hotel inventory. So then again, we might come to a conclusion that all these 3 forms part of a single cash generating unit. So why is it important that we should look at the CGUs? Because CGUs are the level at which you accumulate your cash flows, determine whether at that level there is an impairment trigger or impairment adjustment or not. So if your CGU assessment goes wrong, you might have in one class of assets you might have impairment, in other class of assets you might not have impairment. So long as you do an incorrect CGU assessment, you might miss out impairment adjustment. So it's very important to exercise significant professional judgment in determining CGUs. These examples will help you to at least think on the right lines. The next example is again on a flagship store. Flagship store is nothing but the first of its kind store of its kind of any new product launch or new kind of business, that kind of store, and it's located in a very prime locality. Now the store, they know when they started itself that it is going to make loss because they have invested heavily in that store, and they know that it takes time to pick up, for the store to pick up, right? Now the question is, so when they look at the numbers, the performance of the store is in line with their expectation, even though it is a loss. So first of all, should we say that the store has impairment triggers? And if yes, how should we assess CGU of the store? Also, one more question is, would it be a corporate asset? So before going to the last bit, so if the store is a flagship store, let's understand from company side what it is trying to do. It's trying to project a product. So they want customers to feel the brand. They want to ensure that the brand gets more visibility. That's the reason they have set up in a prime location, right? Now, if there are certain other flagship stores, then you might want to probably say all these flagship stores form part of one CGU. That might be one way in which you might want to do this. Or the other way to look at it is, say for example, along with the flagship store, there are other stores in the same location. Now, because of this flagship store's presence, the other stores are getting business. So it's very much possible that you might see in small cities and small towns that you will see a branch, and then you will see that there are a lot of branches coming across in the city. And not surprisingly, these people even run branches at nook and corner of the city, even though they make losses. That's because they want their brand presence to be felt. They want to know, they want to ensure that they have that reach with that line of customers, and then they make money at overall, and even if in some cases they have lost, in the other cases they will have profits, So in that particular case, you might want to look at a region of stores as a CGU against each store having a CGU, because a lot of times, if suppose you are say running a retail store, you might give an option to take in one store, return in the other store. Even customers might pick from different stores as per their convenience, because the management would want to ensure that in this region I cover and ensure that these many stores are there. So it's okay if I make loss, say in one or two stores. So then the management will assess these stores as a location. So far whatever examples we looked at, one angle that we have seen is the way customer contracts are structured, how they do the business. We have also looked at how the management is running its operations to determine CGU assessment. Now one needs to balance these two things. Neither one completely decides. Obviously, the way in which you do business will have more weightage. So one needs to understand that a lot of these things, whatever we are discussing, we need to ensure that the judgment that we are putting in from a CGU standpoint, which of these judgments would help you to assess the independence of the cash flows. That's the most important bit that we want to look at it. And even that independence should be the smallest group of assets possible. So, and in this particular judgment, this is where you would sometimes end up saying that the group of stores is smallest or a single store is smallest. It might be a case that single store is smallest, but whether it is independent or not, should we look at it at region level or should we look at it store level? This is where we will have to do a lot of brainstorming in terms of how do we want to put it. So let's look at one more example now. So this is again the example that we spoke at the beginning. So there are there is a plant Y and there is a plant X, both in the same entity. So raw material for plant Y, say significant raw material used for plant Y's final production is an intermediate product bought from plant X. So plant X feeds into plant Y. Now, 80% of Y's final production is sold to customers outside the entity. X products are sold to Y, and all prices related margins are passed on to X. So we need to understand here that X also has got outside market, Y also has got outside market. Now in this particular case, both X and Y's products have got outside market, and one product is fed into the other product. In this case, how do we assess CGU? So if depending upon how the particular things are in this particular example, in both cases there is a possibility that each of these plants have independent cash flows, because even if today Y doesn't buy my product, I can sell this product independently to outside market. So one can assess that because of the way in which the active market is present, both X and Y will be separate CGUs. On the other hand, if there is no active market for product X, then product X and Y together will be one CGU. So this is another area of judgment where one needs to consider. And it might happen that product X might even sell prices to product Y without passing margins. But when you do CGU assessment, say for the case that you conclude both CGUs are different, product X, the price of product X and the price of product Y, in both the cases you need to take arm's length price. So product X price, even if for an internal transfer perspective you have taken an arm without passing a margin, for the purpose of CGU assessment you can take the arm's length price or the market price that you would otherwise sell to an independent third party. So we are coming to the last example in the CGU assessment. So this is again a different industry we are looking at, shipping industry. So let's understand that in the shipping industry, each ship basically is capable of generating cash flows. Again, here the specific case, the way in which the contracts are structured, there are specific details given on how contracts are structured. There are different contracts with different customers. Customers will block space, and the space they can block across ships, and all the vessels are fungible in terms of how contracts are. And the pricing of the contract is very important. It's not vessel specific. That means vessels, whichever vessel that you choose, in all these cases the pricing is same. So if I book vessel B, a particular slot for say a particular space, then for me the price of that particular space is the same space in another ship, the price is not changing. And all these decisions are made by class of vessel wise, and they are not linked to actual revenue generated by that vessel. So clearly the investment and disposal decisions are made at the entire class of level wise, not in line with a particular vessel. That's also an important thing, because like we discussed in the other examples before, you might make loss in some stores, you might make profit in other stores, or the hotel example that we discussed, you actually have all these vessels are seen as one pool of vessels, right? From where you can interchangeably give spaces to your customers for shipping the goods. So this is where again another classic example where the indicator is towards a single CGU rather than each ship being a separate CGU. So this with this we completed the CGU assessment. I think then we are left with we'll now discuss having discussed CGU assessment, we will now go to the next topic. So once you know what your CGUs are, you also have to ensure that you take all assets relating to that CGU. for the purpose of impairment assessment. So typically, if we look at the balance sheet, you will have PP&D, you will have intangible assets, and then you will have a lot of other assets and liabilities. Now, which of these items would actually come in your CGU assessment? So this is one area of caution which everyone has to exercise. We do impairment assessments, but then are we completely taking all assets and also liabilities in certain cases, whether they are actually being included as part of the impairment assessment or not? It's very important. So looking back, now we have certain assets and also certain liabilities mentioned here. We will discuss if each of these line items would form part of the CGU or not. So for simplicity's sake, let's assume that there is only one CGU. Now, non-current assets, whether they are forming part of CGU or not. Obviously, like we discussed, PP&D intangibles would come under the ambit of Ind As 36 clean. We have to take it. Now, government grant, deferred income. So if there is a government grant, so long as the grant actually pertains to an asset, normally you would deduct it from the asset, or you would have an option to recognize a deferred income and you would amortize over the life of the asset, so long as the asset is relating to the grant is relating to the asset. Now, in this case, you would have to consider this as part of your CGU. Normally, you wouldn't, but then because if the grant is specific to the asset, if you are de-recognizing the asset, you need to de-recognize the grant. So because they are closely related, directly in fact. So that is another word of caution. You need to look at all the items in your balance sheet before you conclude what to be included, what not to be included. Lease liabilities, very interesting. So from a 116 standpoint, let's first understand that ROU asset has to be included. That isn't there in the slide, but like I said at the beginning, 116 ROA assets has to be included. Now one needs to understand that again, lease liabilities and ROA assets are closely connected. If you are obviously what is real ROA asset? ROA asset is nothing but it establishes that you have a right to use that asset over a period of time. Now, lease liability is nothing but present value of all minimum present value of lease liabilities, right? So we need to understand that ROA asset and ROA liability are closely related. And if you are taking ROA asset, in all practical instances, you also have to deduct ROA liability from a CGU perspective. So one also needs to understand here that I will show you one practical example on how ROA asset and how ROA liability will determine the recoverable value, how it will impact the recoverable value and how does it impact the impairment. I'll show you one practical example. But essentially lease liability will form part of the CGU assessment, but instead of adding, you will subtract lease liability. So debtors and creditors. So again, to make things simple, I said there is only one CGU. Now, when you actually calculate your cash flows, one also needs to take changes of working capital into account. So all the assets and liabilities which are in the nature of working capital would essentially form part of the CGU, so long as they belong to that CGU. So if there are multiple CGUs, then you need to split your debtors and creditors under the respective buckets and then assess the working capital changes. Now, cash and bank balance. Cash and bank balance would not form part of the CGU because cash and bank is a result of the operations. Impairment is a futuristic assessment. So you would, cash and bank is already realized. So you are only trying to see from here based on the next 5 years cash flow or next whatever years cash flow, whether the carrying value is recoverable or not. So that will not come into picture. Employee benefits. Again, this is excluded from the ambit of the standard we already discussed at the beginning. Cash flow hedges. So cash flow hedges is, again, it comes under Ind As 109. It's again not covered under the ambit of standard, but one should also understand that if the cash flows are such that when you are estimating, you cannot separate them. Probably you might want to include the corresponding asset and liability so that there is no mismatch when you do impairment calculations. But technically, you cannot take cash flow just because 109 instruments are scoped out of Ind AS 36. So carry forward losses. Now, again, when we speak about CGU and we speak about assets, we only speak about the assets which are um, actually used in the process of generating cash flows. Carry forward losses are more tax related items which will not come under the ambit of Ind AS 36. So it will not be considered. They are not specific to any asset or CGU. Even for an asset to become a corporate asset, it should have the ability to generate cash flows, but not independently. And carry forward losses are tax liabilities or tax assets, so they will not be forming part of the CGU. So so far we have looked at the carrying what assets will be included and what assets will be excluded from CGU. So now we are getting into the recoverable value assessment. So from a recoverable value assessment standpoint, we have uh, fair value method, fair value less cost to sell method, and we have one value use method. So first we will discuss this and then we will move to value use. So either of the methods can be used. Just let's understand that the company can choose what method it wants to use. It can even use both the methods. The higher of the two can be taken for the purpose of arriving at recoverable value. So the first method, fair value less cost to sell, basically is nothing but the exit price. To be very clear, fair value less cost to sell is nothing but the exit price of the asset. Right? Now, there are, if suppose today I am selling the asset from an arm's length perspective, what is the price that I am going to get from a knowledgeable willing party is the price that I would expect to arrive at using fair value less cost to sell technique. Again, this essentially goes back to Ind AS 113 on how the fair value measurement principles apply. The only difference is the items which are selling costs and the related direct costs are not explicitly stated in 113 that items, but still you need to adjust to arrive at fair value LCS under this technique. And the preference is always will go based on level 1, level 2, level 3. The most observable and quoted prices would be given the first preference, and then second preference will be given to direct observable inputs, and third preference will be given to um, no unobservable inputs, which are again very judgmental. One needs to understand that when you are using fair value LCS technique, you have three options available. You can use either a market approach or cost approach or an income approach. Typically, the valuation experts assess the reasonableness of each of these methods. Sometimes they give all the three methods, they give you the valuation numbers, and companies would kind of internally assess to see which method is most appropriately suited to their business, and then they take the respective approach for the purpose of recoverability assessment. One needs to understand that finance costs and tax related costs, income tax expenses, do not form part of cost disposal because they are not directly relating to selling of an asset. You might still have to pay finance costs because of a different reason, because you already have an internal borrowing or something, you already have a borrowing or something like that. But only costs which are directly related to the disposal, like what? For example, if there are costs where you need to pay to a regulatory authority because you are disposing the asset, that is a direct cost. Stamp duty, registration charges, legal costs which are directly relevant to the disposal, all these costs will be considered. And if there is a liability which is closely connected to a particular asset, that liability has to be adjusted when you are arriving at fair value less cost of disposal. We will look at one example as to what that is in our upcoming slides. So basically, we have this particular slide in front of us. It will give you a high-level overview on the entire impairment review process. Maybe I just spend 2 minutes on a slide to kind of refresh whatever we discussed so far. So if you look at the slide, it first starts with are there any indicators for impairment? Right? If there are indicators for impairment, then the asset that you are looking at from an impairment perspective, whether it is capable of generating cash flows, that means whether you can determine recoverable value for that asset or not. If you can, then you will go ahead and determine, and then you will assess if the asset is the carrying value of the asset is greater than the recoverable value or not, and then you will take the impairment decision. Now, if that's not the case, then you will identify the CGU to which the asset belongs, right? So then the decision box goes down to identification of a CGU, and then if goodwill cannot be allocated to individual CGU, this again, suppose if this particular asset is in this particular context is a goodwill, then you need to look at the level of aggregation of even goodwill. Sometimes you cannot even determine at which level you need to allocate goodwill. It might be a CGU or even a group of CGUs. You might even have to go to a higher level of aggregation. So then you are coming to a decision to see if your carrying value is greater than your recoverable value, and then you take a decision. So interestingly, again, you see the right hand side of the decision box. We are saying even if there are no impairment indicators, like we discussed at the beginning of the presentation, for assets which are under construction, for assets which are having indefinite useful life, you still have to go ahead and do impairment assessment, whether or not there are impairment indicators. Very, very important, guys. Let's ensure that this point is not missed out. If there are assets which are having indefinite useful life and assets which are under construction, intangible assets under construction, and including goodwill, basically, then definitely you have to test the particular asset for the purpose of impairment, and then the decision table continues about CGU identification, goodwill allocation, and all that. Finally, you will impair the asset, and then on either on pro rata basis or on specific identification basis, and the process ends here. So we already discussed about fair value less cost of disposal. I would want to just discuss few more points in this particular context. So the focus of fair value assessment is based on the market participants assumption. It's very important to understand this. As a third party, you would have a limited information about the entity. Today, if suppose some company tries to buy some other company, unless you ask for information, the other company is not going to give you, right? So there is so much information that you can estimate based on the market information that you have on that particular asset and the assumptions that you make as a market participant to decide the value of that particular asset. So this is where you need to fundamentally understand the difference between the value in use technique that we are going to discuss at a later stage and the fair value less cost of disposal technique. Market participant assumptions. The focus is on the market participant assumptions on the value that can be derived from that particular asset together with that liability would represent the fair value cost. This is where you would again approach to decide which of these three strategies you need to see, whether it's income approach or market approach or cost approach. Now, we already spoke about disposal costs and stamp duty, etc. I'll not repeat that. The other aspect here is that business reorganization costs and employment termination costs. Should that be taken into consideration in fair value LCS or not? So let's step back for a moment. So you have taken a decision to sell a particular CGU, and you need to retrench the employees. So someone might argue that the termination costs are arising out of the asset decision that you have taken. So why should we not adjust the employment termination cost to determine fair value less cost of disposal? So one needs to understand that while there might be a consequence of uh, you know uh, winding up that particular CGU, one needs to understand that this is a financial decision, or the consequential decision, or the outcome of that particular asset being sold is the result of employment termination. How you might still want to absorb these employees, that's up to you, but you have taken in this case decision to terminate the employees, right? So technically it is still independent, because disposal of asset, or I would say the computation of fair value of the asset when you want to dispose, has, while it might have a consequential impact on other aspects like employee termination and all, uh, by that aspect itself is not independent, in the sense that when you want to sell, there is no rule that you need to return the employees. You have taken a business decision to do that. You might want to reorganize. That's all up to you. It's all internal, right? So still you can sell the asset, and whatever costs are directly attributable to selling the asset, those are only your relevant costs. So now the other aspect that we should discuss here is, if there are any assets that you are buying would result into assuming certain liabilities, you need to take them into consideration. Now, what are these? So again, I would go back to uh, mining example. Okay. So in mining industry, uh, when you actually have a mine that you are using to extract a mineral ore and further processing it and all that, you would have to ensure mine restoration. So there is a process of mine restoration you are obligated to keep the mine to its original state after you complete your mining. So you need to have certain costs accrued in the books towards fulfilling this obligation. It's called mine restoration costs. A similar thing is also there in the oil and gas sector, where you have decommissioning and restoration liabilities to bring back the asset to its original state. So typically these costs are capitalized along with PP&D as part of the standard Ind As 16. So now, if you are buying the asset, you have no option except to assume that liability. It's as simple as that. So in that particular situation, when you are assuming liability for that particular asset due to a legal consequence, you obviously have to reduce it from your fair value estimate, in the sense when the buyer is determining the price of that particular asset, you would also price factoring the liability takeover. That means I will show you one example by way of an Excel sheet on how it happens. If you have a asset of 100 rupees and there is a liability of mine restoration for 20 rupees, essentially the carrying value which will be compared to the fair value will be 80. So when the buyer is quoting you the price, you expect that he quotes after taking the liability into account. So that's the liability assumption that we are talking about. So you would apply the same principle even in VIU technique. So even if under value in use technique you arrive at cash flows, you have to subtract the assumed liability, and then you need to compare it with carrying value, which also has the reduction of the assumed liability. So I think at this stage, I will just show you that example. 1 second. Abhishek, can you see my screen? Hello? So I'm just assuming that you can see my screen here. Basically, uh, let's look at this example. We have a net block value of the asset of 200 rupees and an ROE asset of 100 rupees and a lease liability of 120, right? So let's look at this example, which has the decommissioning and restoration aspect that we are talking of, the one that I have highlighted here, right? So now, when on the year one, when you actually determine the D&R cost, you determine the D&R cost to be 100 rupees, and that was capitalized along with the property, plant, and equipment. For presentation purpose, I showed it separately here. At the same time, you can see that from a D&R provision perspective, this number might be different. This will be on the liability side, this will be on the asset side, right? Now, D&R provision will be assessed annually, and the effect of D&R provision will go to P&L after the initial recognition. So, essentially, when I compute either my value in use or fair value less cost to sell, okay, say let's assume for example's sake, the fair value less cost of disposal is 400 rupees, right? Now you need to subtract the D&R provision and the right of liability, lease liability number. Both these numbers will be subtracted, and you will arrive at the net VIU or net fair value less cost to sell, whatever that might be, and then determine apple to apple. You would compare them with the net carrying value. So this is the net carrying value. This is the net carrying value of the asset, right? So you can see here that first what we have done, we have taken all the assets on the balance sheet. In this case, the D&R asset that is capitalized, the original asset that is capitalized, and the right of asset that is capitalized. So in this example, we are looking at both the right of asset and the D&R together, right? Now, the lease liabilities also have to be subtracted as part of the net carrying value computation. So as the D&R provision. The net effect of both is the net carrying value. This carrying value will be compared to the value in use or the fair value computation, where you would subtract only the provisions. Your cash flows are based on the estimate that how much ever asset you sell, how much the money that you are going to realize in this particular process, and to match it with the carrying value, you have to also subtract the related provisions relating to these assets, right? And then compare. That is when you will determine if there is an impairment loss or gain. Say for example, your fair value of the asset is only 350 rupees, then you will end up having an impairment loss of 50 rupees in this case, because you are only able to recover 100 rupees, whereas your carrying value is 150, right? So in a 400 case, what is 400 in our case? 400 is nothing but your total assets here. You will have a no impairment situation. So effectively what we are saying is you need to recover your assets. So these numbers basically will not be factored in your VIU or VIU computations, essentially because I will again explain you in the later slides that these are subject to different discounting considerations. The discount rate considerations for lease liabilities and D&R provisions is not on par with value and use technique. So these liabilities essentially would have to be valued under different assumptions than the value in use or fair value computation, due to which we have a situation where you need to reduce these provisions from the value in use computation or fair value computation and then compare it with the carrying value. So let's go back to our screen. So we looked at the practical example which will help us to understand uh, how the assumed liability would impact the impairment assessment, right? So then we are moving on to the next concept. Again, within fair value less cost of disposal, some of the practical questions let's discuss before we conclude this particular topic. So whether depreciated replacement cost can be considered as fair value or not. Now, one of the acceptable approaches under 113 is cost approach. Now, what is depreciated replacement cost? So there is a debate even under international GAAP that when you're talking about uh, cost measurement principle, the cost approach as such being used as the basis for the valuation, one needs to understand if that is a representative of the value of the business or not, in a sense that if that only represents the cost of that particular item rather than the price that market participant would pay for buying that particular asset, the international GAAP does not support the use of depreciated replacement cost. So finally, what we need to understand here is that if a company would decide to take depreciated replacement cost for the purpose of fair value assessment, they need to demonstrate that this price is being viewed by the market participant to judge that this is based on the pricing based on which uh, I want to buy that particular asset, because this is the cost that I would incur to set up the operations after considering aspects like technological obsolescence, physical obsolescence, and all that stuff, and then say this is the price that I would pay to the company based on which the fair value is being determined. So that perspective of market participant is very important to support depreciation replacement cost as a technique for the purpose of fair value, but nevertheless the standard permits to use depreciated replacement cost. Now the other thing is the fair value less cost arrived based on income approach will it be same as VIU. So we haven't discussed about VIU much, but very broad level, I will discuss the VIU technique as well. VIU stands for value in use. So value in use technique concentrates on income approach, where the idea is to calculate the assets present value of cash flows using discounted cash flow technique. Again, from a market perspective, that there's a discount rate that you need to take, which the market participant would take for that similar asset, specific asset. The cash flows are also specific to that particular asset. So that is VIU technique. Now, if I take income approach in fair value technique, I would essentially do the same thing in the VIU technique. So how are these answers different? For example, if I take a fair value less cost of disposal with an income approach, there also I would calculate the present value of future cash flows using discounted cash flow technique. In the VIU also I do the same thing. So that doesn't that mean that both the approaches would give me same result? That's the question we are discussing. So it might not, because when you again look at fair value less cost to sell technique, the market participant is free to make assumption on how he wants to derive the benefit out of that asset with respect to uh, taking additional factors into consideration, which the VIU technique will not allow. For example, the market participant might take future capex, considering the potential of this particular asset. He might take future capex into account and estimate the fair value as cost of disposal, which is not allowed under VIU technique. Under the VIU technique, you only have to calculate cash flows with the assets present condition. So that kind of uh, you know uh, creates some difference between the DCF technique when you apply fair value LCS and VIU, because the assumptions that market participant would use might be different from the assumptions which you do based on VIU. Just remember one thing, VIU technique is asset based, it's asset specific. The risks are asset specific, and the market participant would not know how much you know as an internal company. So from a market participant perspective, there will be additional factors that you take into account when he tries to arrive at the value of that particular asset. So again, let's understand that if we are deploying fair value technique, usually it will be done by valuation expert. So you have to feed him with a lot of information to actually arrive at fair value LCS. A lot of companies go for VIU technique. Some companies also go with fair value LCS technique. Sometimes industry also decides which technique you want to choose. There are a lot of listed companies also using fair value LCS technique. So basically that's point number 2. And for the question number 3, we already discussed this. The answer is no. You can stick to any one method, and then you can assess if that method helps you to arrive at the impairment conclusion. If suppose one of the technique does not, for example, you use fair value LCS technique and then you have an impairment provision, you can still calculate VIU and see if you are ending with same result. You can take higher of the both the amounts and designate that as the recoverable value, and then determine the impairment provision. So for point number 4, what we are discussing is in case under Ind As 105, you have not satisfied conditions, like for example a binding sale contract, etc., due to which you are not able to designate that asset as a 105 asset. And if you compare uh, fair value LCS value of that particular asset with the VIU, would you expect a difference or not? So here is the catch we need to understand. So from a VIU perspective, normally the intention is to calculate cash flows when the asset is in use. But in this particular case, you don't have an intention to use the asset because you already have an intention to sell it. The only thing is the conditions under 105 are not satisfied. So essentially, you also have to kind of compute the cash inflows from the sale of the asset, and then you need to estimate the selling cost and all that. So essentially, you might end up having the same answer that you would have got with fair value LCS technique. So both will approximate mostly to same number. So from a fair value LCS technique, one needs to be careful about which entities we are choosing this technique on. If you have more of level 1 and level 2 inputs, it's okay to take fair value LCS technique. But if most of the inputs are not observable, uh, how much comfort you can get as a company or as an auditor would be debatable. If you use fair value as LCS technique, it all depends on the industry that you are in. If there are a lot of comparables and you are able to ascertain the value with the available comparatives and all, then it is great. Otherwise, we would have a tough time to get comfort on the, even if there is a value doing the calculation, if the inputs are totally unobservable, it's difficult to form judgment on the value derived using fair value LCS technique. That's one point which I want to bring to everyone's attention. So now we can jump to value news technique. I think let's take a 5-minute break at this stage, and we can resume again at 6:30, and then we can continue value news technique from here. 1 second. So we can begin the session by 6:30, 6:32. Thank you. Welcome back. Can you confirm if you're able to hear me, Abhishek, or?
Yes, sir. Yes, sir. Yes, sir. You can, sir. You can start, sir.
Thank you. Thank you. So we have covered till fair value less cost of disposal. We have covered till that. So now, as part of recoverable value assessment, now we are looking at value in use, computing the value in use. The next few slides are very important to everyone. Value in use is the most commonly used technique across the industry to compute recoverable value. So we are going to discuss general information on things that we need to be aware when use value in use technique and specific issues as well. So like we discussed, value in use is nothing but estimating the present value of future cash inflows and outflows up to the time the asset is disposed. That means in a way you are actually deriving the present value of cash flows throughout the entire cycle of the asset. The other thing is we have to decide on an appropriate discount rate to these future cash flows. So both of them are two significant aspects of VIU, determining the future cash flows, inflows and outflows, and the appropriate discount rate. Now, again, this is purely from the standard. How do we determine inflows and outflows? We use estimates, right? Inflows and outflows are nothing but estimates, management estimates. So these estimates are developed using the inputs from the business teams or economic teams within the organizations. They have a long-range estimate plans for that particular company, specific to that particular asset, and they develop the estimates based on their based on the economic conditions and the targets that they have. At the same time, taking into consideration the present condition of that particular asset. So it's very important that we take comfort on these estimates. So the biggest estimate here is inflows and outflows. So the first thing that comes to my mind when we speak about inflows and outflows is how do I audit, because I am from the audit side, and the same question will also be there from the industry side as to how do I prepare. So I think from a preparation standpoint, for them, even for companies, it's not that easy to develop these estimates. The estimates have to be reasonable. That's what the standard says. Now, what is reasonable assumption? Reasonable assumptions are again judgmental. You need to form a view whether it's likely whether these inflows and outflows are can be met by the company. Some of the things that I would usually look at it is I would look at the current set of economic conditions. I would look at the performance of the company after the assumptions are given to me for a foreseeable period of time. I would even look at the past performance of the organization to see how this historical data is, and then I compare that with the present set of assumptions. The most important of all, some of these assumptions are auditable and some of them are estimate driven. The one which are auditable, like say for example, gross margin. The gross margin that the company takes as part of the assumptions usually should link back to what gross margin I've been earning already. And if there is a change, as an auditor, I would like to understand what is the change. Even management, when they want to question the business, they I'm sure would use the same kind of analogy. They want to understand how the gross margins are okay, how the revenue numbers are okay, whether we can achieve the revenue numbers with the present set of constraints that we have. And let's be very clear again here. The assumptions should stem from the asset's present condition. You cannot assume that the future business will expand. You can imagine, you can assume that the future business will expand, but with the existing facilities, what is the maximum that you can do? That is what user assumption should support, not beyond that, right? Then preferably, I've seen a lot of companies running it past to their board of directors, and they take their feedback on the reasonableness of these cash flows, and they usually take board approval as well, which would give a sanctity to some of these assumptions that is being used, because these are very significant assumptions. And one also needs to understand that if the firm has robust future plans on how they want to restructure, how they want to play around the business in terms of getting more from the existing economic conditions. So long as those are not committed restructuring plans, you cannot take the benefit of cash flows arising from those restructuring plans. So to give an example, say the company wants to rejig their existing CGUs and they want to follow a different business model. So based on which they believe a lot of synergies are there, a lot of cost savings, and then you have more margins and more revenue coming into picture. So the thing is, what is already there in the books that substantiate this restructuring, and whether this restructuring which we are discussing is already being uh, part of management plan before closing their books of accounts as on 31st March 20 or not. For say for a current year if we are doing this. So before the year end, I would say these are very important for us to uh, technically decide from Ind As 36 whether you can allow that restructuring as management or as auditors to um, decide on the future forecasts. So the forecasts are based on the restructuring which is not yet committed by the management. Now, what is being committed by the management? Being committed by the management, you need to look at 3-4 things. One is there has to be conditions existing as on the reporting date already, that balance sheet date already, that the company has taken note of these and they already have planned these things, and there are communications which can substantiate that, and there has to be some level of approval from those charged with governance or the management to say that these restructuring plans are already approved, and you need to start incurring those costs even before the balance sheet date. See, typically restructuring is not that simple, right? You have to, when you are projecting restructuring benefits, you also need to ensure that the restructuring costs are also factored. Some of these costs would come in the books as well. Some of the costs might be futuristic. But the thing is, from an Ind As 37 standpoint, you need to book all the costs which are akin to restructuring if you want to take benefit of the restructuring period to be forming part of your cash flows. This is very fundamentally very important, a gray area, because a lot of companies might want to do restructuring. So it's very important that these plans are already formalized during the year end so that you can substantiate to the board or to auditors that restructuring is already in place. We have already incurred the cost. We have already taken those steps, and then you can go to the next stage where you actually take those benefits in the cash flows, both inflows as well as outflows. The other point to note is we're talking about 5 years, which is suggested by Ind As 36, unless a longer period is justifiable. If you use a longer period, in fact, there is a disclosure requirement under the standard to use more than 5-year period. So the point here is the long range plans. Uh, Usually why we want to restrict to 5 years, because you might not have visibility beyond 5 years. That's the intention of the standard. Now you might have a situation where you have a contract which gives you evidence that the cash flows are beyond 5 years that you can foresee. I'll give you another example. So in the toll industry, toll companies have contracts with NHAI, National Highway Authority, concessionaire, where they can get the entire throughout the toll contract period. The road companies will know how much cash flows they are going to get. They only have to manage cash and the flow of traffic. There are certain toll arrangements like that. Not every toll arrangement falls in that category, but there are certain toll contracts where you get a fixed consideration for a specific time frame from the regulator, and you just have to maintain the asset. So there, I've seen where the model there is different. They don't stick to 5 years. They take the entire tenure of the contract and they decide if the impairment is there or not. So those are special cases where you will have information. But suppose if you are dependent on the market conditions to estimate your revenues, obviously you can't justify a longer period. And if you justify, you need to show some contracts on hand. So companies and the auditors have to be vigilant that if you take period beyond 5 years, you need to have the necessary backup documentation to substantiate the change on why you want to take beyond 5 years. So the other thing is beyond 5 years, what is going to happen? You will calculate terminal cash flows. So up to 5 years, you will have a clear visible data on inflows, outflows. You will take a reasonable growth rate assumptions on the revenue side, on the gross margin side, on the cost, fixed cost, variable costs. So after considering all this working capital changes and all, you also have to ensure that the terminal cash flows are computed properly. Very, very important, guys, because sometimes the way in which the numbers are structured, significant cash flows come from terminal cash flows only. So in the terminal cash flows, you essentially have a revenue number, cost number, and a growth rate number estimated, which is called as long-term growth rate that you take as part of the terminal cash flow number. This long-term growth rates, a small change in the long-term growth rate percentage is so sensitive that it results you in giving a huge impairment gain or huge impairment loss. So they are very, very sensitive assumptions. So one has to take a tremendous professional care and skepticism to estimate or audit these growth rate numbers. So I have seen in some of the industries where they take 0% growth rate and they compute terminal cash flows. In some cases, they take 2%, in some cases 3%. It all depends on the industry that we are talking of and the kind of information that you have on how the future business of that is. And in all these cases, usually the valuation team again will get involved. They will kind of deep dive into why this growth rate is appropriate or not. So a lot of information, a lot of care has to be taken to audit these numbers to see the sensitivity on how we are impacted with these growth changes, ensure that they are the most reasonable at this stage. Again, one has to consider macroeconomic factors like how the country is doing, the industry is doing, to see if these growth rates are appropriate. So for example, in Europe economies, the growth rate might be very small, but in Indian economies, maybe it will be a slightly higher because of the economic characteristics of the country. So these are some of the considerations one needs to be mindful of. So we are now, we will discuss some interesting aspects within the VIU with practical examples. So the first thing is whether we should take pre-tax cash flows or post-tax cash flows. So guys, this is very important to understand. The standard clearly says that you should consider pre-tax cash flows. Now, in most of the cases, when we get the weighted average cost of capital rates, essentially WACC rates are post-tax cash flow rates. And we also see that the incremental borrowing rates, a lot of other rates, again go back to post-tax cash flow rates. So in this situation, how would one estimate a pre-tax cash flow rate? I think fundamentally, let's just understand why the standard wants us to take pre-tax cash flow rate. Again, based on the discussion which is done from an IASB standpoint, the pre-tax cash flows essentially would neutralize the effect of specific deferred tax asset, deferred tax liability related distortions, and some of the assumptions around the carry forward losses related aspects and all that, because it's difficult to estimate all these things at a CGU level as to how much will be the cash flow distortion because of deferred tax and the other tax implications, and to factor them in the present value computation practically will create a lot of challenges in terms of even the discounting aspect. Like that deferred taxes are not subject to discounting, again the fundamental premise of the standard. So this essentially takes back to the discussion on why we have to take only pre-tax cash flows. So does that mean that we will not estimate the tax cash outflow? Still not. We will still estimate the cash tax outflow, because if you are saying that you are computing post-tax cash flows, that means you will still compute the tax cash flows, but you will not take the possible deferred tax adjustments. you would understand the asset value, you will compute the tax base, and you will see how the tax base is getting recovered over the period of time, and then compute the post-tax cash flows. So we will see one small example, a very simple example I will take you through. Hi, administrator, can you confirm if you can see my screen, please? Hello? Okay, fine. So we will look at the example that we are discussing. So first, let's again go back to the fundamental concept of why we are taking pre-tax cash flow and not post-tax cash flow. So basically what we are saying is that, let's take a simple example that you have to, you are actually trying to compute a business model to arrive at a set of recoverable cash flows of say 300 rupees. So essentially, to get to 300 rupees of post-tax cash flows, you assume that pre-tax cash flow is 400 rupees and then 25% tax rate you assumed. In this particular case, the 25 rupees tax cash flow that you assumed, you are making an assumption that the entire VIU cash flow is equal to tax base. So there is no question of deferred tax adjustments here. So that's where fundamentally uh, whatever number or whatever percentage the tax rate might be, the focus is on getting a VIU cash flow where the tax base is equal to VIU number that we are talking of. So essentially we are always looking at pre-tax cash flows either ways. So what I have done in this particular example is, first we have taken an asset. The asset's carrying value is 1,757 rupees, right? Now these are the projections for the next 5 years, right? And as part of the projections, we first took the 5-year number in this particular table, and then based on the tax loss, if we assume that the entire asset cost is deductible in the year 1, right, then we are computing after deduction how much is the tax inflow or outflow. Okay, then we are computing the post tax cash flows. So based on this, if I take apply the present value technique, the total cash flow is coming to 1,757. So one might say that, okay, what is the big deal in computing the pre-tax discount rate? Because the main point here is your discount rate also has to be pre-tax discount rate, not just pre-tax cash flows, right? Now your post-tax discount rate is 10%. That is evident from, say, incremental borrowing rate, or there might be a listed company where you can evidence with the same single asset portfolio, you are able to evidence that you can establish the 10% rate, right? So then now with a tax rate of 20%, you might want to simply gross up the pre-discount rate to 12.5%. However, if you do in this method, you will not get to correct discount rate. I just want you guys all to be conscious that when I compute the impairment provision, we have to compute the impairment provision based on pre-tax cash flow and pre-tax discount rate. So we are discussing in this example on how to compute a pre-tax discount rate. We all will know what is post-tax discount rate, because post-tax discount rate is what the valuation team will do their own research, and they or the company would assess the incremental borrowing rate or WACC rate as a starting point, and then they make all the adjustments, which we will discuss again in other slides, what adjustments would come to the discount rate. And then we are trying to see how to compute a pre-tax discount rate. That is where we said, why can't we simply gross up the post-tax rate to pre-tax rate and say we take 12.5. Okay. Now, if I take this 12.5, so we all know that we are expecting a post-tax cash flow of 1757. We know because these numbers are all rectified, right, based on our assumptions. So if I take a 12.5% and if I apply the discount rate on these cash flows, the question is, would I get 1757, yes or no? But I would not get it. I would get, you can see here I have taken 12.5% here. All the pre-tax cash flows I have taken. I have got a discount rate with of 12.5%. I have got a NPV of 1770. So there is a difference of 41 rupees between the value that we computed versus the value that we have here, right? So basically the idea is that you arrive at a discount rate using iterative technique. So we need to use an iterative technique to ensure that we get to the result that we want, which is 1058 in this case. So once you take that, you will have a correct discount rate that you will use for the purpose of pre-tax tax. So that's the whole idea basically. So then you would essentially have 1078 cash vis-a-vis what you have now at 11.2% discount rate. So the difference you can see what we got using gross up is 12.5% and what we got using iterative technique is 11.2%. So 11.2% is the correct discount rate in this particular context. So going back to our presentation. Hope you are able to see my screen. At least you are able to see my Excel only. Just 1 second. Yeah. Okay. So we discussed about pre-tax cash flow and post-tax cash flow. Now moving on. The next question is that should we consider any future cash outflows towards capital asset? So again, let's understand that when we discussed earlier, we said uh, the entire cash flow assessment has to be done based on assets present condition. Now, this is very careful that we need to be here. When we say that the asset has to be assessed in its present condition, you still have to incur certain cash flows to operate it at the same level of capacity. To that extent, you might have a cash outflow towards capital asset. So that would very much form part of the standard when you calculate cash outflows during the projected period. So you can't ignore that cash flow. So that is nothing but replacement capex. Even in terminal cash flow, you need to consider replacement capex. Without that, you will not be able to arrive at terminal cash flows, right? Auditing this number is also very important. You need to get comfortable also on the replacement capex and the capex which is required to maintain the particular asset. That is where again your past history on the replacement capex estimate from business is very important in terms of how you audit that number. Especially in manufacturing, this becomes very significant. So yeah, if you ask whether it should be taken into consideration or not, so far it relates to maintaining the existing capacity, the answer is yes. But if that is to expand further into the new capacities which you are again trying to bring the effect of the cash flows, then the answer is no. You only have to take the asset in its present condition. Now, one more point I would like to tell you. Say, for example, there is an asset which is under construction. So your plant and machinery say is in 50% completion stage. Now, what should I do? Should I take the balance capex and should I take cash flows arising from the balance capex? So that this makes the issue more interesting. So we need to understand that management already committed to this particular project. You already might have issued POs. Just imagine if the project is in 40-50% stage or even 20-30% stage or whatever. You already might have issued a lot of purchase orders. You might have already have a plan on when you want to complete it and when you want to kind of launch it. So all these costs again will come under the ambit of the next 5-year cash because they are already committed projects. So in their outflows, the capex assets have to be considered, and you can also consider the corresponding cash inflows arising out of those assets. So that's on point number 2. So the next point is what would we do in case if some of the CGUs are essentially foreign currency dealing. Okay, how do we do that? So if there is a branch outside the country, and then for that particular branch, if it's a CGU by itself, and you have to assess the recoverable value using VIU technique. The process is simple. All the computations have to be done in foreign currency. The inflows, outflows, the discount rate has to be based on that country's factors, country-specific factors, considering that asset. And then after computing everything, you will arrive at present value of cash flows. You simply convert the present value of cash flows into your functional currency using spot rate. That is what the standard requires you to do. You need not do any complex calculation there. You do everything in foreign currency, and once the present value of cash flow has come, you simply have to convert it. That's the expectation. So now what should we do about the events after the reporting period? So we discussed this already. If there are any specific events which impact our impairment, so long as the events relate to items existing on the balance sheet. COVID is a classic example. So for some companies, with March closure, already COVID is there on the balance sheet. The impact of COVID is there on the balance sheet. So there is debate across the industry to kind of record the impairment charge because there's already triggered. In some companies which are December year ending, the COVID came just after the year end. So the event is not existing as on the balance sheet date. So a lot of exhaustive disclosures are given in these companies so that the users are aware of the potential impact that the COVID might have on the financial statements. So a lot of companies have given a general note saying that we are in the process of assessing, and the note would cover some company specific factors. Otherwise, most of the companies would have written that either it is material or we are in the process of assessing. Some companies said it has a material impact. So far as the current year is concerned, March 20 itself, a lot of companies have COVID as a event already existing on the balance sheet. So a lot of companies already would have triggered the impairment assessment. So not just this, any other factor which we want to evaluate from an impairment standpoint, so long as that particular factor exists on the balance sheet date, that would be considered. Otherwise, you have to evaluate the disclosure depending upon the intensity of the factor. So restructuring cost, this also we discussed. Suppose you want to take the benefit of the proposed restructuring. As per Ind As 37, you have to ensure that the costs are provided. That is when you can think of taking the benefit. Now, what is this traditional versus expected cash flow approach? Very important, guys. This is very important. So, traditional cash flow approach and expected both are elaborated in one of the appendices in the standard itself. The traditional cash flow basically goes on the premise that there is only one set of cash flows, one discount rate, single discount rate. So all the variations relating to the cash flows which we discussed at the beginning of the presentation. All the variations have to be factored in that cash flow itself, and the discount rate also will have all the factors that you need to consider. It could be country specific risk, asset specific risk, economic specific risk, any kind of variabilities in terms of timing in which the cash flows are received. All these factors will go either in the discount rate or in the cash flows. So that's the traditional approach. Now, what is this expected cash flow approach? The expected cash flow approach goes a step beyond, and it actually goes with scenario analysis and probability assessment. So what one will do is, say I'm using income approach to, so VIA technique uses income approach. So basically, if you are estimating cash flows, you would have scenario analysis. What are my cash flows going to look in the worst case, and how are my cash flows going to look in best case, and how are my cash flows going to look in most likely case. So you will have three set of cash flows for an example, and you assign probabilities to each of these cash flows, and then you form an expectation on what is my final cash flow for the purpose of impairment assessment. So this method is increasingly becoming popular in these days, because the amount of comfort that you can get from adjusting the cash flow variability is far more better when you incorporate the same factor in your discount rate. So you need to understand how the model works. Each of these risks have to be taken care. Now the question is whether you will incorporate these risks in the cash flows or in the discount rate. One of the case. You will not duplicate by putting it both the places. For example, if your discount rate is already taken care of these factors, then you will not touch your cash flows. If cash flows are adjusted, then the factor will not be again taken care in the discount rate. So multi-scenario cash flow will give you more comfort in terms of understanding the numbers, and your discount rate can incorporate country specific, local specific risks, and general expectation of the market participant on the specific asset, and you can compute the net present value. So fundamentally, between traditional and expected cash flow approach, there is no right or wrong answer on which approach you need to use. But expected cash flow approach would give you more chance to understand the numbers better. In some cases, like for example, the cash flows are flat. For example, say take real estate rental industry. The cash flows are flat. They are subject to one common contract. Your cash flow streams are fixed. Then you might go for traditional cash flow. If you are expecting a lot of probability variations, then in some industries where you can't estimate the demand correctly, you need to go with, it's better you go with expected cash flow, because that gives you more clear picture on how you can set expectations. So this is on expected versus traditional cash flow approach. The nuances are indicated in the standard in one of the appendices. So we, having discussed value news, now we are discussing about discount and growth rates. So like we discussed, two important elements in value news. One is cash flows, which we have discussed, and second is discount rate. We already discussed the precaution that we need to take when you are assessing cash flows. So from a discount rate perspective, it has to be a pre-discount rate. We already saw the pre and post discount rate computation as well, in terms of how the interplay works. And let's understand that it should reflect current market assessment of the time value of money. So a lot of companies that I've seen, and some of the questions that usually we get asked is, why can't we take the weighted average cost of capital of the company as the discount rate? The first thing we need to understand is, even a weighted average cost of capital is a post discount rate. So we need to get to pre-discount rate that we already discussed. The second thing is, one needs to understand that the discount rate is what you expect from a market perspective, considering the asset specific factors. For example, today, if I have a old house in Adayar, the rent that I expect is different from the rent that I expect, say, in Paraipaka, right? So Adayar is comparatively more a premium locality. Now, how I finance the asset to get to that return is not relevant. Still, Adyar would give you that level of rent, premium rent that it gives you, irrespective of how you finance that asset. Similarly, any other locality. So, what return that the market gives you specific to that particular asset has nothing to do with your working capital structure. However, why we take whack of a listed company with a single portfolio, which is akin to the industry that we are, is that a listed company is expected to have the current market assessment based on which the pricing is determined. So we believe that it is more reasonable that market assumes that that is the return that I would want if that particular asset is bought by me or used by me. So that is very important. The concept, getting the concept is very important, that we can start with weighted average cost of capital of the company, but eventually you have to make all the adjustments and come to the market assessment, which ultimately justifies the risks that are specific to that asset and the time value of money. So again, one needs to consider the country specific factors, because if your asset is in UK or US, you cannot use the discount rate of that particular country to the Indian discount rate. So you need to, even if you need to see that your CGU is also divided by geographical location, uh, and then the cash flows are computed accordingly, because the discount rates between these two things will be, these two assets will be different. So you cannot do a common calculation. So basically we spoke about discount rate. Now we'll discuss about long-term average growth rate, which again we touched upon some time back. So the growth rates should reflect the industry growth and the country's growth, and they should not be significantly high when we compare these macroeconomic factors. It's like I said, in Western world, the growth rates that you take will be very minuscule. It will not be very high. We saw this, the growth rates we take in India on a comparative basis. But either ways, very strong justification and documentation is required to substantiate, and the sensitivity analysis is also very important. You need to get comfortable that these growth rates reflect the industry growth rates before finalizing. So we already covered the first point, whether WACC rate can be used as discount rate or not. Entity's capital structure, this is also discussed. We said that entity's own capital structure cannot be a reflective of the discount rate to be used, because the market participant's assumption on how he wants to get benefit of that particular fixed asset or asset as such would not be representative of my weighted average cost of capital. Now I might load more risk because it's a leveraged company that will be taken care of the discount rate, but essentially one has to look at the expectation on what the asset can do for me in terms of return. So will there be any impact on impairment assessment due to application of 116 using a different discount rate? So here is where it gets more interesting. So when you do your cash flows, the first question we want to ask ourselves is whether we should take leases in our cash flows or not. So typically, if you look at the lease computation, the discount rates that we use for leases might not coincide with the discount rates that we use for our CGU. Incremental borrowing rate concept is there even in 116, but if the asset specific discount rate that you finally arrive is different from the incremental borrowing rate, you end up comparing not an apple to apple uh, comparison in terms of using a different discount rate and pulling the cash together. It is for this purpose that you can totally exclude the leases related computation from the domain of VIU calculations, and simply subtract the present value of minimum lease payments from the derived VIU calculations, like I showed you in the last example. And even when you arrive at carrying value, you need to subtract the lease liabilities. So eventually, the return that you need to make will be including the ROE asset plus the net block value of the asset when you ultimately compare the cash flows. So that will be taken care. So let's go to the next topic, goodwill. So again, let's understand that this goodwill basically is again from business combination standpoint, the premium that one pays for the asset uh, after the beyond the net identifiable assets which are computed using fair valuation principles and together with the minority interest that is taken into consideration. So one needs to again understand that uh, how do I sort of allocate goodwill first between CGUs to determine the impairment assessment, because goodwill will sit under intangible assets. Your tangible assets will have CGUs. Sometimes it's difficult to identify a direct CGU for a goodwill, because the way in which you want to derive the benefit of that particular acquisition might fall into multiple CGUs. Sometimes it might not restrict to a single CGU. So in that case, you will have a tough time in first identifying or allocating goodwill between different CGUs. So here one point I would like to say again, if I look back AS 28, it says reasonable and consistent basis. But in case of Ind As 36, it actually says based on synergies, you need to allocate goodwill even if the assets and liabilities are not there in that particular CGU from where you are getting the goodwill. Even if that is the case, you still have to allocate CGU. So that's very fundamental difference between AS 28 and Ind As 36 that one must acknowledge. Now, from this particular perspective, first thing we need to ensure is that we identify the level at which the goodwill is monitored. It's very important. Now, when we discussed about CGU assessment also, we said that one might look at regional level, store level, even at country level if you are a global company, on how you are monitoring your business. So goodwill also has to be identified at that level at which they monitor for internal management purpose. However, the level of aggregation at which you monitor the goodwill cannot be larger than your operating segment. So here the highest threshold for you is operating segment. The lowest threshold can be anything. It can be even a single individual asset. It can be a CGU or a group of CGUs. But one needs to understand that it cannot be larger than the operating segment itself. Again, this is very judgmental, because if you are having multiple CGUs, sometimes it's easy to identify the synergies and then you say that these three CGUs are getting benefited from this particular acquisition. So I will use a basis reasonable to allocate goodwill between these three entities. Sometimes it's difficult at that stage, you need to use your judgment. But either ways, when you arrive at the judgment, the level of aggregation should consider the level at which your management actually is looking at that particular businesses to say that this is the level at which I'm monitoring their performance, and that level should not be larger than the operating segment. These are the two inputs that go into that particular judgment. Now, sometimes what happens is even the standard acknowledges that it's difficult to do this allocation immediately after the acquisition happens, because you might not have enough time between the time you complete an acquisition and you do all this allocation. So the standard actually gives you a leeway to kind of you know recognize provisional goodwill based on the business combination principles, and then you can revisit that provisional goodwill in the next year and correctly allocate it. So you might even not allocate some goodwill for any of the CGUs because you don't have sufficient information on hand to do that assessment. In that cases, a specific disclosure is also required, which the standard clearly lays down that in case you are not able to allocate the entire goodwill, you have to give a disclosure in this particular instance where you cannot do that assessment before the year end. Right? Now, one needs to understand that why we are doing all this. Again, from an impairment perspective, you are trying to ensure that the CGU is complete with the goodwill allocation. That means when you are disposing that CGU or any assets in that CGU, you have to de-recognize the goodwill also along with that CGU. That means in computing the gain or loss for that particular asset, you essentially have to take into consideration the goodwill component of that particular CGU when you compute gain or loss, right? Now, the timing of the impairment assessment uh, and the goodwill assessment might coincide or might not coincide, but in all likeliness, usually I have seen companies doing it at the same time. And then uh, the typically in the interim period, they test the goodwill for impairment along with the CGU assessment. Um, and if you are not having any goodwill at all, then you only go by indicators, like we discussed at the beginning of the presentation. Only when you have a goodwill, you are inevitably forced to do every year impairment assessment, because it goes notwithstanding any impairment indicators. That will change the timing of impairment. That's what one needs to acknowledge. Now, since we spoke about identifying synergies, we'll just look at a couple of examples to kind of assess this. So, from a mining industry perspective, if there are processes like smelting, refining, and if you buy a mine ore today, and there is no active market for the direct extract from that mine ore. However, when you do some smelting and refining, the final product has a market. So in this particular case, you take all these three as one CGU and you allocate between goodwill between all these three. So when we talk about synergies, and just this example, we can look at how synergies are are applied. Basically you already have some other mines. You are already incurring some fixed costs in those mines. So by having this mine itself, you are able to leverage on the existing fixed costs and say that this will form part of my total CGU, because of which I am obtaining more synergies. And even if the individual mines assets and liabilities are not included, in these other specific PP&D smelter, at the end of the day, you are calling everything as one CGU, and then you are allocating goodwill. So that is one example. The other example is more akin to aggregation of CGU level. So there CGUs might be different. It's an airline industry example. So you bought another airline because of cost pressures that you have in this sector. So, and then when you bought another airline, naturally you are trying to reduce the common workforce. You are trying to streamline your centralized operations. So when you do that, your CGUs might still be structurally same, but then because of the synergies, you will have certain operational benefits, because of which goodwill have to be assigned to other CGUs, even though that particular asset might not be there in that CGU. This is a classic example where the CGU aggregation happens beyond but that CGU. In the first example, goodwill is getting allocated to the same CGU where the assets and liabilities are. But in the second example, your goodwill is getting allocated to a different CGU, a different CGU, which is getting synergy benefits because of this particular acquisition, right? That is what we are trying to discuss. So corporate assets, again, very interesting topic. So corporate assets, what are corporate assets? They are again assets which help you to generate cash flows, but not independently. So today, without a corporate office, no company can function because they are like heart and soul of a company. Unless the branch overlooks all the operations, streamlines everything, purchases, centralized policies, and all, individual branches cannot run, right? And they are very fundamental to business. Then the question will be, how do you assess these assets also for impairment? Sometimes your corporate building itself will be a huge value. So now, how do you assess them? Now, one needs to understand that corporate asset, because it's not capable of individually generating cash flows, you need to look for the right CGUs to place the corporate asset and apportion it to test the corporate asset along with the CGU assets for the impairment purpose. So if suppose there are different businesses and different corporate assets, you can identify which corporate asset belongs to which CGU, and all the assets and liabilities of that particular corporate asset can be moved to that CGU, or vice versa. If it only caters to if you cannot specifically identify, you need to use a reasonable basis to apportion the corporate assets spanning across different CPUs. In either ways, you need to ensure completeness of all the assets which are tested for impairment. The way I would do it is I would have a net book value check of both tangible and intangible assets before I see if completely all the NBV assets are subject to impairment or not. That's how you have to get comfortable on the completeness, and that's where you pick these kind of corporate assets and other assets which are not tested earlier for impairment. Right? So we will again now discuss on the impairment loss recognition and reversal. See, impairment loss is straightforward. You first have to compute impairment loss. If suppose your carrying value is less than the recoverable value, the difference is your impairment loss. But you first adjust the goodwill allocated to the CGU, then only on pro rata basis you carry out other adjustments. This is fundamentally one thumb rule you need to remember. First, you always have to reduce goodwill, then only you come to other assets on pro rata basis. Now, you need to just ensure that the recoverable amount of an individual asset cannot be determined. No impairment loss is recognized for that asset if the related CGU is not impaired. So this even applies if the asset's fair value less cost of disposal is less than the carrying value, which you have to get comfortable on. Right now, one more thing you need to understand is at the end of each reporting period, you need to see if actually there are triggers for impairments even to get reversed. So as you see that economy picks up in the future, it's not just sufficient for you to watch out the impairment indicators, you also have to watch out for reversal indicators. It all depends on the way in which business is doing, and if the economy picks up, impairment even might not exist. But one thumb rule again you need to remember is, even if impairment reversal is computed tomorrow in the next year, goodwill impairment reversal cannot be readjusted. Or goodwill impairment once reversed is gone. That's it. There is only one exception to that. We will discuss that one exception. That is based on provisional goodwill. If there is an adjustment required, that is the only place where you can reverse that to partially. That I will show you with one example. Otherwise, any changes on impairment reversal of goodwill, downward reversal adjustment cannot be reversed again, which is again different from AS 28. AS 28 carve out specific exceptions to reverse the impairment, but that is not allowed under Ind As. So these are the main things one needs to understand from a impairment loss recognition and reversal. And just remember the order of priority. One has to reduce goodwill first, then only on pro rata basis you need to carry out the impairment adjustment as well as even reversal. The same thing holds good. Now we will look at the deferred tax impact because of recognition and reversal of impairment with an example, and we will also look at the provisional goodwill calculation, and also one example we will look at both the cases. So before we look the example in 1 and 2, let's see the last question here. It says, in what circumstances an impairment loss or reversal might not impact income statement only, but it impacts reserves. So this is interesting. So let's say we have revalued a PPNB. So the effect of revaluation, upward revaluation, will be taken to revaluation reserve. Now, if that kind of asset is impaired, I will not book that impairment in the P&L. I will book the impairment in the respective revaluation reserve only. So when you impair, you basically reverse the revaluation reserve, and when you adjust the same reversal, again you increase to the extent it is decreased earlier to the revaluation reserve. So beyond revaluation reserve, if you have to impair, that adjustment will come to profit and loss account. This is akin to what we used to do under AS 28 on how the impairment reversal works. So I think let's quickly look at the first two practical examples. Okay, so now we are looking at the first case where one second, deferred tax, right? So we will take a simple example. The carrying value of the asset is 2000 rupees. The tax base is 1500, right? Now this 2000 rupees has 500 rupees of goodwill, right? 1500 rupees is the asset value, 500 rupees is the value of goodwill, right? 500 goodwill, and then the tax base is only 1500. Now goodwill, just let's assume that for tax purposes you can amortize it over a period of 5 years. Just let's assume for this example purpose. Now subsequently what happened is you have an impairment of 700 rupees after the year 1. So year 1 the picture is clear. 2000 rupees is the carrying value of the asset, which includes 500 rupees of goodwill, right? 500 rupees of goodwill. Then you have a tax base of 1500. So then this is your taxable temporary difference, because your carrying value is higher than the tax base in this case. So you have a DTL here of 125 rupees. Now you posted an impairment reversal of, you posted an impairment of 700 rupees. So that is bringing down your carrying value. What one needs to understand is this 500 rupees will first get knocked off the impairment out of 1500 for 700. 500 gets knocked off from goodwill. So only balance. So from this 2000 rupees, if I subtract 500, so the net carrying value will be 1300 after deducting the 200 rupees from the net book value, which does not has goodwill adjustment, right? That is 1300. So one needs to compute the revised deferred taxes based on this. Now earlier it is DTL, now it has become DTA. You can see this because at the same tax rate, your earlier deductible taxable temporary difference has now become deductible temporary difference. To the extent of 50 rupees, now you have a deferred tax effect. So this is the implication from a deferred tax perspective. But what one needs to understand is, you from a goodwill standpoint, again this is very important guys, Ind As 12 does not permit recognition of deferred tax asset on initial recognition of goodwill. However, subsequently, because of taxable or deductible temporary difference, if you are subject to uh, these differences, then to that extent you can recognize deferred tax on goodwill. Now in this case, you would actually have in the year 1, you would have say computed and taken benefit of 300 rupees in your income tax return. To the extent of 300 rupees, you will have a DTL, because you would essentially you already took benefit of this particular 300 in your income tax return. In the year in which you sell this asset and you earn some profit, you have to actually pay tax. To the extent of that, you will have a DTL. So this number will not be reversed, irrespective of reversing this 500 rupees of impairment, because your impairment reversal is cannot be reversed again. Once an impairment goodwill impairment reversal once happens, it happens forever, right? But you have already taken deduction, so your DTL will still remain in the books in this particular case. So the DTL gets accumulated over a period of time, and suppose if you are able to sell the asset in profit, that is when you will adjust this DTL. Till then, you would retain the DTL in the books because of this particular situation, right? So this is on deferred tax. So we will now discuss on the provisional goodwill, right? So what is the concept of provisional goodwill? We already discussed. So we are basically saying that say we have a we don't have enough information on the year end to compute the goodwill, and arising out of business combination, you are not able to allocate the goodwill, sorry, and then based on that you have computed goodwill on a provisional basis. Now in the same year you also recognize an impairment charge of 1000 rupees. So the way you would do it is, in that year you would have fully impaired this goodwill, even though you recognize it on provisional basis. The same goodwill you would have impaired. Now, in the next year, you realize that this 1000 rupees of impairment reversal, which you have booked here, is not at all needed. Okay. Now, what the standard says is that if you actually worked out the goodwill to be 400 instead of 500, to the extent of 100 rupees, you can reverse the goodwill. 400 you can't reverse because you already know that the goodwill once fructified. To that extent, if impairment loss is already there in the books, you cannot reverse. But because of this being provisional in nature, this extra 100 rupees you can reverse. And of course, balance 400 rupees, whatever is there, you can reverse. So basically, you can reverse a total of 600 rupees put together for the impairment purpose. This is the only situation where you can reverse the goodwill. Otherwise, there is no other circumstance where your goodwill adjustment is warranted. So this will be net of 100 because we are only looking at other assets. So it will be 500. So 500 plus 100 will be 600. This is the goodwill that you will reverse in next year. This 400 is impaired. That's it. Because you, even though you believe that there is no impairment, an impairment once done is done. Only because of provisional goodwill you are getting this 100 rupees benefit. So these are the two examples. One second. So going back to the presentation. Yeah. So I will discuss one more practical example. Basically, what we are talking of is what will happen in case there is a minority interest. In case there is a minority interest for your subsidiary that you have purchased, and then if goodwill, suppose impairment comes, then how would you determine the uh, allocation of that particular goodwill from a impairment standpoint? So one we need to understand is how we are arriving at goodwill. Under how we are computing minority interest is very important. Okay, so basically what we are trying to say is that under business combination standard, there are two ways of determining minority interest. One is using net identifiable assets, the percentage of which will be applied for the minority shareholding that you are entitled to. Second method is fair valuing the minority interest. Now, if you are computing minority interest on the initial recognition using proportionate share of net assets, you essentially have to gross up goodwill. I will show you an example on how we are grossing up the goodwill. The simple logic is that if you are when you are recognizing goodwill using proportionate share of asset method, the goodwill is exclusively your goodwill. It does not have the goodwill of minority shareholder. But in fair value NCI approach, it is also having the goodwill of that particular minority interest also embedded in the minority interest itself. So there is no issue, there is no question of grossing of goodwill when you are comparing the when you are doing the impairment assessment. So in case of proportionate share method, you have to gross up the goodwill. Now, when you will not gross up, only when you completely sell off your NCI stake, then there is no requirement to gross up. That is the first scenario. And in the remaining two scenarios, whether your stake is increasing or decreasing, your gross up will still remain. That is what we are discussing in scenario 3 and 5. In scenario 2, 4 and 6, whether you are selling the entire stake, if you are selling the entire stake, obviously there is no minority interest, so there is no requirement for gross up. Okay. But in other two cases, also there is no requirement to gross up because already the fair value number has the goodwill component to that extent, and the goodwill is representative of total goodwill of the company. So that is what we are talking of. So from a disclosure standpoint, there are numerous disclosure requirements under the standard, but a lot of disclosures gets triggered when you actually do an impairment. So there are specific impairment disclosures where you need to even discuss the CGU level data, segment level data on how the impairment losses are recognized, how the goodwill is allocated, and even in the FA schedule you have to give class-wise asset description on how much impairment is recognized, and then how much impairment you are reversing. And you have to also give information on significant judgments used in the impairment assessment. I'll just show you a couple of examples just to kind of take you through what disclosures will be in some of the listed clients. So you can look at this annual report here. It's Tata Motors annual report. So you can see that uh, first they are talking about the recoverable value, which segment is actually being tested for impairment, and you need to also explain as per the standard what conditions led to impairment. That is where they are saying due to change in the market conditions. They are not given a very elaborate disclosure, but these are some of the things I am trying to match from the disclosure to this particular standard requirement. And you need to give details on what is the recoverable value, what is the method finally used. So here they have used fair value less cost of disposal because the VIU number is lower than this, and then they have determined the impairment adjustment. And here they have specifically also given the method that is used, because if you are computing using fair value less cost of disposal, you also have to specifically mention what method you have used and what inputs you are using as part of the method to uh, compute the fair value less disclosure. That also is given by them, and they have given that multiple that is driving their assumption. And you can see here they have actually used unabsorbable assumption. uh, so we need to see how they have got comfortable from a company standpoint in this particular case. And they have given the impairment loss at class wise, describing how much is the impairment loss in each of these cases. And they have spoken about the sensitivity to key assumptions, again with the disclosure requirement in the standard. So you can also look at Vedanta, another financial statements which has adequate factors, adequate disclosure requirements given as to what is prescribed by the standard. So I think with that we have come towards the end of the presentation. Um, we just have one slide which talks about AS36 and AS28, Ind As 36 and AS28 differences. We spoke most of these differences when we were discussing the presentation itself. Um, See, at the end of the day, the fundamental difference, there are no very large differences that I would say. One big difference is the impairment reversal difference that we spoke of. And the other thing is from in the consolidated financial statements, if you have associates and joint ventures, uh, earlier AS28 is not covering them, whereas Ind As 36 is covering them as part of the impairment assessment. And AS28 scopes out discontinuing operations because of Ind As 105. But if you look at the earlier framework, while AS28 does not directly have it, AS10 prescribes cost or NRV, whichever is lower. So that is one difference between both cases. And yeah, I mean, we have covered these general differences. Other than that, the disclosure requirements in Ind As 36 are more robust compared to AS28. So with that, we have come towards the end of presentation. Um, I think at this stage, thank you all, thank you everyone for being patient with the presentation. Hope the session helped. I can take down any questions at this juncture which any one of you have. So Abhishek, would you want to kind of pitch in? Abhishek, you are able to hear me?
No, one second, sir. One second, sir. I will inform sir. One second.
Yeah. Hey Abhishek.
Yes, sir.
Yeah. So any questions? I can take it up. Otherwise, from my side, the presentation is through.
Any questions have come, Mukesh?
No, sir. No, sir.
Okay, so I think we've reached the end of the presentation. Thank you so much, Virinchi, for a very lovely presentation on a very important topic. And really, all your examples were very, very useful. And I was making notes as I was listening to you. So I firstly want to thank you for the excellent presentation and your time during this crunch time period. I also want to thank all the participants who joined in and interacted and who have been listening in. Thank you all. Stay home, stay safe, and take care.
Thank you. Thank you very much. Thanks for the institute for giving me this opportunity.
Thank you, sir. So can I end the session, sir?
Yes, we can. We can end the session.
Yes, sir. Okay, sir.